So finance, this is the art and science of managing wealth. It's about making decisions regarding what assets to buy and sell and when to sell those assets. Its main objectives is to make individuals and their businesses better off. Financial management is generally defined as those activities that create or preserve the economic value of an asset, of the individual, the small business, or the corporation. Financial management comes down to making sound financial decisions. Financial intermediaries, such as investment and commercial banks, assist in the movement of money from the lender to the borrower and back again. The process is termed the cycle of money, and its main objective is to make sure all participants are better off. So let's consider a mutual fund. A mutual fund issues shares that are bought by individuals who save and invest part of their paychecks. The pooled funds are invested by the mutual fund company in shares that are issued by firms which are trying to raise capital for growth. The firm pays the dividends periodically, which are received by the mutual fund and passed through to their shareholders, or reinvested in an additional shares, and the cycle of money starts again. The mutual fund managers earn a fee. The firm whose securities are bought are able to raise capital for growth and future returns, and the mutual fund shareholder earns dividends and capital gains. Thus, all of the participants are generally better off. Finance is often partitioned into four main interconnected and interrelated areas. There's corporate finance, which deals with financial activities that support the acquisition, the investment, and the repayment of capital. There's investments, which involves activities centered around buying and selling financial assets, such as stocks and bonds. Then there's the financial institutions and markets, which are concerned with organizations' functions and activities of financial intermediaries and forms that promote the cycle of money. And then we have international finance, which adds the elements of multinational dealings, country risk, and exchange rate conversion to the three areas previously mentioned. It's important that we understand that these four areas cover the main activities of finance, and they are interconnected, and they are well organized into a network for the cycle of money. Financial markets are the forum where buyers and sellers of financial assets and commodities meet. The financial markets are classified by a few things. The first, the type of assets trade. Is it going to be an equity security, a debt security, derivatives, foreign exchange? The maturity of the financial asset. Is it a money market or a capital market? The owner of the financial asset that is traded. Is it in the primary market or is it in the secondary market? And then the nature of the transaction. Is it a dealer's market or is it an auctions market? Within business, the financial manager who is entrusted with the responsibility of determining the best repayment structure for those borrowed funds so that we make sure debt obligations are met on time and we have sufficient funding available to carry out our normal day-to-day operations. It's important to stress that the responsibility of budgeting and managing one's own finances throughout this financial management process, whether it's done within the business setting, and you can also apply these same things to your personal lives. When we think about financial management, we break it into three categories. First, there's capital budgeting. This is the process evaluating, the planning, the evaluating, selecting, and managing long-term operating projects for the company. And then we have our capital structure. This means by which the way the company finances its activities. For the public, it may be a mix of equity and debt, which means stocks and bonds that are sold to the investors and owners. And then lastly, working capital management. We need to manage the day-to-day operations to ensure that we're meeting the needs through the current assets and current liabilities of the company. This is also returned to as short-term financing activities. As a finance manager, your main objective is to make an investment in financing decisions that increase the cash flow of the firm, thereby increasing the current stock price and the current market value of the equity in the company. The first thing you hear in business is that we're looking for profit maximization. There's also this misconception that maximizing stock price is best done by maximizing profits. In fact, other blind pursuits of short-term profit maximization by managers have resulted in negative long-term effects on the firm. We also focus on maximizing the current share price. At first glance, this may seem like a goal of maximizing the firm's stock price leads to trade-offs that could end up hurting the interests of the other stakeholders of the firm, such as the employees, the suppliers, or even the customers. The actions that must be taken to raise the stock price often end up benefiting those stockholders as well. So by raising the stock price requires actions and decisions that lead to higher future cash flows. Good employees, happy customers, and strong community ties also support a strong and vibrant company with better prospects for improved future cash flows. We want to maximize equity value. In this case, privately held firms, the goal of maximizing the current share price translates to maximization of the firm's equity value. The market value of its assets minus the liabilities or the claims against it. That's your equity. The relationship between the owners or the principals of the corporations and the managers, the agents, who are appointed by the owners to run the corporation is termed the agency relationship. The very future of such relationships is fraught with opportunities for conflict. Since the owners want higher stock prices while managers who are empowered to make the key operating decisions can often stray away from the main goal of maximizing shareholders' wealth and grant themselves excessive perks, high salaries, and pad their offices with luxurious carpets, much to the dismay of the shareholders. So the problem of motivating managers to act in the best interest of the shareholder is known as the principal agent problem. Some methods that can be used to minimize agency conflicts include supervision, outside audits, performance-based compensation contracts, such as stock option plans and bonuses tied to earnings per share. The agency theory is the name given to the process surrounding the recognition of the principal agent problem, and ways to align agents to the interests of the principal. Costs to align the agent above a straight effort contract or ensure performance at the contracted level are agency costs. And then we have concerns as it relates to corporate governance and business ethics. Corporate governance deals with how the company conducts its business and implements controls to ensure proper procedures and ethical behavior. Most companies and managers go about business in a fair and honest manner. However, occasionally some managers do get involved in actions that fall outside of the purview of ethical behaviors while pursuing higher profits and lower costs. Laws concerning employee safety, truth in advertising, pollution control, illegal bribes, issuance and the sale of securities, provisions of financial information have been enacted by Congress to ensure that fair competition and ethical behavior exists. The Sarbanes-Oxley Act of 2002 requires, among other things, that the CEO and the CFO attest to the fairness of the financial reports. The company must maintain effective internal control structure around its financial reporting, and the company and its auditor assesses the effectiveness of those controls over the most recent fiscal year. Now, publicly traded companies are required to file quarterly and annually reports to the Security Exchange Commission, or the SEC. Privately held firms compile financial statements to keep track of their performance, file taxes, and provide information to its owners. Thus, a knowledge of the relationship between the three primary financial statements, which include the income statement, the balance sheet, and the statement of cash flows, is essential to understanding the condition and the health of an organization. Accounting income that is reported in the financial statements is typically not the same as the cash flows of a firm. Since most firms use accrual-based accounting principles for recording revenues and expenditures. Under this accrual accounting, firms recognize that revenues at the time in which they are earned, and expenses match those revenues. And because that is the case, your financial statements don't actually reflect the cash inflows and the cash outflows at that same time. The cash balance shown on the balance sheet is a true reflection of the cash available for the firm. And the change in the cash balance at that point is in the statement of cash flows. We are able to track where and how the cash flows in and out of the organization. The income statement, the balance sheet, and the statement of retained earnings, and the statement of cash flows are the four financial statements that internal and external users are able to assess the health of the company. The balance sheet, it lists all of the firm's current and fixed assets, as well as its liabilities and the owner equity. And these are the accounts that are used to finance those assets. The balance sheet also is the home of our accounting equation, and it helps us to recognize and see and assess that the total assets will always equal to the sum of the total liabilities plus the owner's equity. The balance sheet has 5 sections. It has the cash account, the working capital accounts, which includes current assets and current liabilities. It has the long-term capital accounts, which show the gross and the net book value of all of the long-term assets that the firm invests in from the inception of the company, as well as their accumulated depreciation. And it helps you to see what the current value of those assets are. We have our long-term liabilities, which includes all of our outstanding loans that are greater than 1 year or the current operating cycle. And then we have our ownership accounts, and these include all our capital accounts, which includes our common stock and our retained earnings. The income statement shows the expenses and the income generated by the firm over the past period, typically over a quarter or a year. This can be recognized because all of our revenue will be listed first, and then our expenses will follow after. So it's our revenues, then our cost of goods sold, our depreciation, and then our operating expenses. This will be our earnings before interest and taxes, or our net or our operating income. From our earnings before interest and taxes, we deduct our interest expense to get our taxable income, or our earnings before taxes. And then finally, we will apply the appropriate tax rate, then we'll deduct those taxes, and then we will have our net income or our earnings after taxes. Our statement of retained earnings is our next statement. And from our statement of retained earnings, we will be able to determine our previous retained earnings, our net income for that period. Together, we combined, we will be able to assess and determine whether or not dividends will be paid. If so, dividends will be subtracted from that amount, and then we will have our ending retained earnings. Our dividends are only paid out of our retained earnings. Dividends are not an expense of the company. And then lastly is our statement of cash flows. The statement of cash flows identifies how our cash flows in and out of the organization. In our statement of cash flows, or our sources and uses of cash, it's often it's compiled by taking information from the income statement and the balance sheet and organizing it into 3 sections. Those 3 sections include our operating activities, where the cash flows, and then the investment activities, and then lastly, our financing activities. From our operating activities, these are all of the activities that we use in the day-to-day operations in which we are conducting business. Our investing activities are those activities in which we are purchasing or selling our capital assets, those things that we use in our operating activities. And then lastly, our financing activities. These are our repayment of loans, our collections from investments, the purchasing of stocks, the borrowing of money, the payment of dividends. Those activities will be housed in our financing activity section of our statement of cash flows.